Okay, we have confirmation. Monetary policy. The Federal Open Market Committee has maintained the federal funds rate near zero. The FOMC has been providing forward guidance for the target range for the federal funds rate, indicating that the range would be maintained at 0 to 1/4% until specific employment and inflation criteria had been met. Consistent with that guidance, the FOMC has maintained the target range for the federal funds rate at 0 to 1/4%, and this is going to be displayed in figure 46, which is down here. And in December, the committee concluded that the inflation criteria and the forward guidance had been met, and the target range would be maintained until labor market conditions had reached levels consistent with the committee's assessments of maximum employment. In January, the committee stated that with inflation well above 2% and a strong labor market, it expected it would soon be appropriate to raise the target range for the federal funds rate. From June 2020 until November 2021, the Federal Reserve had been expanding its holdings of Treasury securities by $80 billion per month and its holdings of agency mortgage-backed securities by $40 billion per month. At its November meeting, in light of substantial further progress the economy had made towards maximum employment and price stability, the committee decided to reduce the monthly pace of its net asset purchases by $10 billion per month for Treasury securities and by $5 billion per month for agency mortgage-backed securities. At its December meeting, in light of inflation developments and the further improvement in the labor market, the committee began to reduce the monthly pace of its net purchases more rapidly by $20 billion per month for Treasury securities and by $10 billion per month for agency mortgage-backed securities. At its January meeting, the committee decided to continue to reduce the monthly pace of net purchases and conclude net purchases in early March. The FOMC will continue to monitor the implications of incoming information for the economic outlook. They're going to continue to monitor the incoming economic data and would be prepared to adjust the stance of monetary policy as appropriate to manage risks that could impede the attainment of its goals. So basically, this is confirmation that they're going to be doing something in March. So that's good news. So what does this mean? So whatever you think of the repo, I want you to think about volatility. Basically, what they're going to do is in March, they said right here, early March, is all this repo demand's got to come out. And when that comes out, volatility is going to be reduced, liquidity is going to be added, volatility is going to be increased as the liquidity is into the market. So what have we seen for the last year? Basically, the market's been decaying from a liquidity standpoint. So basically, that's going to be reversed, and the liquidity is going to increase, and the volatility is going to increase. I'm assuming that it's going to happen somewhere around March 18th, quad witching, but I'm retarded. So again, seems to be around April. Basically, this report's saying everything worked fine. They talked about the shift away from LIBOR, a bunch of other things. I'll link this below if you'd like to read it. And again, things could change at any time, but as far as I know, look to March and April for something exciting.